This Real Estate Buzz segment is brought to you by McLeod Associates, a full-service real estate and mortgage firm. It's not about the number of homes we sell, it's about the difference we make in people's lives.
Hello mga kababayans natin. Thanks again for watching the Real Estate Buzz on Wednesday with G. Tonji. It's really great to be here today. As you can see, we're out of the office and we're out of the studio at this beautiful home here in Eastvale. With that said, please don't forget, we are your trusted community resource when it comes to real estate and mortgage. We are here to empower you and educate our community when it comes to the real estate world. With that said, let's get into tip number one. I want to talk about the FHA Streamline Refinance. You guys heard about me highlight this in the past, but this is something that's very popular this year where they lowered the mortgage insurance January 26 from 1.35 to 0.8550. So it's benefited a lot of our FHA borrowers by reducing their mortgage payment. We've seen savings of anywhere from $100 to $450 in some cases, which is huge, right? That could be the car payment, that could be activities for the children, that could be a food budget. So if you currently have an FHA loan, give us a call to see if this will benefit you or if you're eligible for the FHA Streamline Refinance. Remember, everything at our office is completely confidential, and we're here truly as a resource to our community. With that said, I also want to get into tip number two, which is the DTI Ratio. Have any of you heard of what that means and how that plays into the mortgage world? Well, DTI stands for debt to income ratio, and that's how these lenders that's what they use to qualify you. So for example, on an FHA loan, the debt to income ratio is 55%, and on a conventional loan, the debt to income ratio is 45%. Let's talk about debt here really quick. When we talk about debt, the lenders look at your revolving credit. So they're not looking at your cell phone bill or your medical insurance bill. They're looking at your credit card bills monthly or your car payment, things that are revolving. And they don't look at the balance, but they look at the minimum payment on these revolving credit cards. Along with that, they take your income. They calculate income based off of your last 2-year W-2s and your income on your year-to-date, on your most recent payment on your year-to-date, and they average that all out. So for example, if we plug in a $300,000 purchase, let's say you want to buy something worth $300,000 and you're applying for an FHA loan and your debt to income ratio comes in at 60%. Well, that means you exceeded the guideline, so we have to lower it, right? Maybe lower it to 280 or 275. But let's switch that to the other side. Let's say we put in $300,000 and your debt to income ratio is 40%. That means you can actually get qualified for more. So maybe we can boost up your purchasing power to $400,000 or $450,000. Again, a lot of times our first-time home buyers are taking advantage of the FHA loan because of the higher DTI ratio versus a conventional loan, which only allows you to go up to 45%. With that, I also want to highlight the CHDAP loan program because CHDAP goes along with the FHA loan. If you saw me on a show recently with G. Tonji, I mentioned you can get into a house with as little as $2,000. This is with the down payment assistance program. If you're interested in this, please give us a call at 909-612-9488. And I want to end this segment with a community or an organization that we recently partnered with. Their name is Patriots and Paws. You can read more about them or find out more about them on patriotsandpaws.org. They're a nonprofit 501c3 organization that helps our fellow veterans. Again, thank you so much for your support. Please follow us on Facebook at Mia McLeod and the McLeod team. Thank you.